process made in the latter half of October. In this report, we are to discuss the financial and fundamental environment surrounding US stock markets and the earnings reports released. Today, we highlight the release of the Fed's interest rate decision, and the bank is widely expected to remain on hold, keeping rates at the range between 5.25% and 5.50%. It's characteristic of the market certainty that Fed fund futures imply currently a probability of 99.5% for such a scenario to materialize. Furthermore, we note the market's expectation for the bank to remain on hold until July 2024 and then proceed with a rate cut. Yet, such expectations could be contradicted should the Fed decide to adopt a more hawkish tone in the accompanying statement and Fed Chair Powell's press conference later on. At this point, we have to note that inflation, albeit slowing down, is still at quite high levels, yet the jump of the GDP rate at a preliminary level for Q3 is markable. Economic activity seems to have increased in October for both the services and manufacturing sector, and the US employment market tends to remain relatively tight. All of that tends to allow the Fed to maintain its hawkish stance and practically prolong the period at which high rates reign over the economy, and probably that may be the Fed's main message in the event. Should the tone actually be hawkish, we may see the market sentiment being contradicting and turning more cautious, and thus weaken US stock markets, which are considered as riskier assets. On the other hand, should the bank's hawkish ease, given the slowdown of inflationary pressures in the US economy, we may see US stock markets gaining. On Friday, we highlight the release of the US employment report for October. The unemployment rate is expected to remain unchanged at the relatively low level of 3.8%. The non-farm payrolls figure to drop to 180K from September's outstanding 336K, and the average earnings growth rate to slow down to 4.0% year-on-year if compared to September, 4.2% year-on-year. Should the actual rates and figures meet their respective forecasts, we will still see the US employment market as being quite tight, given that the unemployment rate remains at relatively low levels and the drop of the NFP figure is understandable given September's outsized rise. Overall, such rates and figures tend to allow the Fed to maintain its hawkish tone and thus may weigh somewhat on US stock markets. Yet the element of surprise may be present and could create asymmetrical market responses at the time of the release. We note that earnings releases of the past week tended to intensify market worries for the path of high-tech US companies, with an adverse effect on their share price. We expect market focus to remain on earnings releases over the next 7 days, as several high-profile companies are scheduled to release their earnings reports. We highlight tomorrow, Thursday, the release of Apple's earnings report. The company unveiled yesterday its new MacBook Pro featuring M3 chips, which are considered to make the laptop scary fast, creating some support for Apple's share price. Tomorrow, we'd like to see whether the mega-cap high-tech company is going to be able to reverse the downward trajectory of its earnings and revenue figures over the past 3 quarters, but would also be interested on any hints about the outlook of the aforementioned figures. On a busy Thursday, we'll also note the release of the earnings reports of Ferrari, Starbucks, Novavax, and Dropbox. On Friday, we get the earnings reports of Alibaba. On Tuesday, UBS, eBay, Uber, and next Wednesday, Disney and Lyft. Overall, we expect that earnings releases could captivate the attention of the markets and create headlines in the coming week. Thank you for watching.